Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Derrick Barker Jr. He is the CEO and co-founder of a company called Nectar that he co-founded with his wife, Brittany. It is a financial technology platform founded in 2021. Nectar specializes in providing flexible capital to experienced commercial real estate operators, bridging a critical gap between the lending market. The company offers mezzanine debt and preferred equity solutions, typically in the $200,000 to $5 million range, a segment that is underserved by traditional institutional lenders. Derrick, welcome to The Wealth Flow. Looking forward to our conversation today.
Thanks for that intro, Keith. I'm looking forward to it as well.
Yeah. I always love to start with people's background, though, where you grew up, and sounds like you met your wife while attending school at Harvard. So I'd love to hear a little bit about that. But yeah, just really always interesting to hear people's background and kind of where, what led them to doing what you're doing today.
Okay. So all the way background, I'm from Atlanta, Southwest Atlanta, or College Park, right outside of it. And my dad was a pilot in the military, and he got out and got into real estate when I was in high school, the end of high school, around the 05, 06 timeframe. As you can imagine, for someone who was a pilot their entire career in the military and got out in 06, 08 didn't go really particularly well for him.
Right. Exactly.
But for me, I was very interested in real estate and entrepreneurship. I started, several companies when I was like younger, pretty young, middle school, high school. In college, I started a very, very successful company when I was a freshman with a couple of my roommates. And then we started investing in real estate because we wanted to go and work on Wall Street. But, again, we were in college in that 08 time, and we felt like Wall Street might not even exist by the time you graduate, so you have to figure out another path. So that's That's how I got involved.
Well, fantastic. And so you went to what'd you go to school for?
I started out applied math and economics at Harvard.
Okay.
I started advanced placement, so I was a sophomore in economics. But I realized that it was all theoretical, so I ended up majoring in sociology, and that's where I graduated with.
Fantastic.
Yeah. So, but that being said, I learned how to communicate ideas and think and research and figure things out in sociology. And I learned how to scrap and scrape and make profits happen with the work that I was doing outside of school. And Harvard was a great environment to get that education too. And that was the education that's really, turned into the business that I have now.
That's fantastic. And you mentioned you'd started a couple companies while in school and just a couple period. Tell me a little bit about some of the other ones as well. Were they all kind of in the finance area, or what were some of the other businesses that you've created so far?
Yeah, I started a financial group. So I was a freshman in college, and I didn't grow up in a economically secure family. It was a very loving, great family, great childhood, but we didn't have a lot of money, and there was a lot of money issues. So I was like, there are a lot of people that are rich here. What do I do? And it was like, and then 06, it was like, do Wall Street. So I started an organization to be connected to business school and Wall Street, and really we taught undergraduates, had business school students teach undergraduates how to operate in business. And we had case competitions and different competitions where the undergraduates would learn, the business school students would teach, but also they have something in their resume. And we pitched to the, have the Wall Street banks be judges. And at the time, Wall Street banks would pay tens of thousands of dollars to judge these competitions where they can get an inside look at the new rising talent that was like really interested and well connected in finance. So we started that. We'd have the banks paying us to come and do, and then '08 happened, and then they were like, "Okay, we'll still come, but we're not going to pay you. We'll send you some pamphlets."
Oh gosh,
the economics went away. But I did that. I did a finance club. I did I started a robotics club. I did or started a robotics organization. I did a lot of just things over the years.
Yeah, that's neat. And so then after you graduated, you worked with Goldman Sachs or at Goldman Sachs for a while, right? Tell us a little bit about that and kind of what that led to eventually you founding Nectar.
Yeah. So I was, even though I was worried about the financial system collapsing in college, it didn't. Go figure. So
right.
Having started that organization where I was connecting to really all of the major Wall Street banks and large private equity firms, it did put me in a position to get a pretty good job at Goldman. I traded structured products, so I was really learning how to price risk in volatile markets when there's uncertainty, and these are very illiquid assets. So I got a really early on learning and they give you a lot of responsibility. So I was taking risk with the firm's balance sheet, buying and selling these illiquid, structured, complex assets, and a ton about just risk. What is risk? What is risk? Market risk? What is product risk? What is interest rate risk? And something that, but I continued to buy real estate. So as I said, I started buying real estate at Harvard. I continued to buy it while I was at Goldman on the side. And by 2013, I had about 500 multifamily units in Atlanta, and Goldman's in New York. And then I decided it made sense for me and what I was trying to do with my career to leave Goldman and pursue that full time. And so that's really what I did, and started a business that bought distressed apartments mostly, and built that's over $500 million worth of assets, buying distressed apartments, renovating them, operating them, and selling them, asset managing, developing, generally working in that distressed space.
Were you doing all these like from the beginning with as like syndications, or how were you doing them initially, or did it all start that way since you kind of had an understanding of that?
Yeah, it started out really as when I was a senior in college, we went to raise a fund. And we went to hit all of anyone who had talked to us, like all the alumni, the people who were like, my roommate had a scholarship. We went to the person who funded his scholarship. We did all these things. And we ended up not raising very much of a fund, but we raised a syndication to do a single family property went well. And then from that, after we got that deal done, then we were able to raise a very small fund, like $1 million and change fund to do single family. And then that did well, and we recycled proceeds to get bigger and bigger deals in the fund, which gave us a track record that we then went to do another syndication, JV partnerships. So every type of way to pull capital, we've done it. We put together the cash to do these deals over time, and eventually you get partners, and you get track record, and you get relationships, and it becomes easier.
That's right. No, that's great. That's great to hear. Yeah. So you just kind of worked everybody you knew from people that were actually funding the scholarships to kind of put it together, and starting with like a lot of people starting with single family and then kind of moving into multifamily, and along the way you built that track record. So that's fantastic. And do you still own real estate in multifamily today?
Yeah, I do. So where most of my capital and portfolio is in Nectar. However, we still own about 500 and change units of multifamily. But we sold the majority of our assets. We aren't buying distressed assets like that. That business, timing makes a lot of sense in markets. Like that's the most important thing. And what thing that I learned doing this is that you can have the best operations, the best execution, the best business plan with the best people, and it matters. All that stuff matters a lot. However, you can have great basis and have a bad management team and a bad business plan and do everything wrong and still make more money. So like,
Right.
so basis matters execution matters a lot and basis matters more. And basis it has to do with timing. And so we got out of doing a lot of what we were doing based on just what was going on in the market and timing and basics. But yes, we still have some assets.
Okay. And so you decided to sell some of that and put it into, and as far as Nectar goes, like tell me a little bit about, obviously you're operating, in the multifamily space, you're having to go out and get debt for various deals. I'm sure you're applying for different mezzanine or, whatever. How are you becoming exposed to the fact that there is a market need for this type of debt?
Yeah, that's a great question. And, it started with, when you are out there starting to build a portfolio, there are two ways to start. You can start with capital and assets and then, or you can start with hustle and drive and not a bunch of capital and assets.
Right.
And those are different things, but what you realize quickly is either way, once you have assets, they're illiquid. So you do all the work to raise the equity and raise the debt, and they're defined markets, very defined markets for debt, less defined, but very defined markets for equity also. But you're building a business. That's the reality. People don't talk about this, but these owner operators, these real estate developers, they also have a business that they are running that is outside and separate for their assets. That business is incredibly hard to finance. That business, in what you see when you're an owner operator is your liquidity is always getting pushed to your assets. You need to buy another deal. It's a great opportunity. Oh, they want a 10% GP co-invest. Okay, so you're putting capital there. Once you get a reputation, you have a lot of opportunities that you wouldn't get otherwise because you have a reputation. Well, now your capital has to go between all of those opportunities. You have 12 properties. 11 of them are home runs, but one of them, in order to get it past this hump, you're gonna have to cut a check, and your money, you're gonna have the money to go to that. And then at the same time, while you're growing, and because you have this track record, you probably really need to hire a couple people to do some of this stuff, and your cash has to go to that. So what I learned is that you have clear paths to raising money on debt and equity for the assets, and if you do a good job and you're prudent and you have a good track record, you can have a low leverage portfolio of cash flowing assets that are illiquid, where on paper you are a multi-millionaire, but in reality you're looking at your bank account and you're figuring out, okay, well, how do I do this deal, pay this payroll, and fund this capital call? And that's what I learned. And early on, I thought it was just because I was young. I was like, if I can just get this $50,000, I will never have this issue again. And then a little bit, okay, if I can just get this, $150,000, I'll never have it again. And then a little bit later, it's like, if I can just get this $1 million, I'm not gonna. and then it's like, okay, just $5 million hole. If I can fix this $5 million hole, I'm never gonna. And it just continues. It's always the same thing. And so I started Nectar really specifically to solve that issue. You have great people. They're prudent. They have great assets. They're running a business. How do they leverage what the track record and the great deals that they have? How do they leverage their actual net worth in order to run a real business, build and scale their portfolio?
Okay, and so the lending is it like a line of credit, or what is it? I guess tell me a little bit more about kind of the what type of debt. I see the range there, but what is it that you're lending? I guess it's secured by some of the assets, I'm sure. But tell us a little bit about kind of how it's structured.
I will. So I would say the primary thing that we are is flexible. And I know that everyone says, oh, we have fast, flexible capital, but it's not. It's like, it's flexible if you do this specific first mortgage structure and all the capital stays in the property and you do all of these other things. We're flexible in that you can really use us for whatever purpose, whether it be funding operations, whether it be fixing an issue in the portfolio. But the structure to your point, is there are some things that we have to have. We're attaching to low leverage cash flowing assets or moderately leveraged cash flowing assets, and we're attaching either as and how we attach is flexible. We can be pref equity, we can be a cash flow assignment agreement, we can be a mezz debt. We can be flexible in terms of like fitting into your capital stack, because there are all kinds of ways to put together a real estate deal. And we're going to look at the way you put your capital stack together, and we're going to fit within it. We're going to be junior to your mortgage. We're going to be senior to your equity. And that's going to be we're flexible except for that. All right. That's not flexible. But outside of that, we can be flexible on how we work. 5-year terms or 1 to 5 year terms. We can have, we have shorter terms. We have people pay us off in 3 months. And we're here to give you liquidity, soft liquidity, attaching to the assets, even if it's in working with your existing capital stack.
Okay, no, that's awesome. There's a huge need, right, for that type of thing. As you mentioned, it's not just necessarily starting out. There's all kinds of reasons why an investor would need that. And that's one of the most frustrating things about being a full-time real estate investor is when you see how much you're worth on paper, but it doesn't feel like it in the bank all the time. So that can certainly be frustrating. Give us some examples of some of the deals and some of the ways that you've structured some things, just so the audience can kind of understand some instances where that would come into play and kind of see.
Yeah. So a couple of examples. I'll talk about a couple of recent examples. So we had a deal where there's a guy who he bought a property with 2 partners. It was a family business. One of the partners was his grandfather, and his father was another partner. And his grandfather was at end of life, and he needs to buy him out for estate planning purposes, which I won't get into the details. Let's just say he needs to buy a partner. And we were able, and it needs to be by a specific day. You need $2 million to buy out a partner. We were able to come in. We looked at the portfolio. We were able to provide the $2 million in about a 10-day period. We were attached to an asset. He had attached to a student housing asset that was really moderately leveraged. They had developed it and they owned it for, at this point, maybe 2 or 3 years. So they had already refinanced out. But the LTV was sitting in the 60% range. We came in behind that lender, gave them the capital that they need to buy out their partner. They didn't want a new partner. They wanted to just own the property. So we had structured that so that they pay us out of cash flow, and we amortize down over the course of 3 years, and our deal would just go away. Our position would go away.
Yeah.
So that's an example. Another example is there's a group that has a large portfolio and presence and based in New Jersey. They have over 5,000 units in New Jersey.
Nice.
They stretching for yield in 2001, 2002. The yields in Alabama are very attractive, and so they went to Alabama and bought some value add. And the value add deals in Alabama didn't go well. So they needed capital to get these deals, clear out the contractor that they had. They're flying their contractor from New Jersey out to Alabama to these projects, but they needed a couple $1 million to get it finished. We aren't set up, Nectar, to go behind distress properties. However, they had these assets that were operating and cash flowing in New Jersey, and we came in behind the debt in those properties. They were borrowed against their equity in those deals, and use it to finish the renovation, get the contractors going down there in Alabama. And again, they paid us off over the course of, these are structured as 5-year deals where they could pay us off over the course of 5 years. They ended up getting a refi in their New Jersey portfolio after about 2 years, and now they've paid us mostly off on those deals. So those are 2 examples of. Does that answer your question?
Yeah, for sure. It definitely does. And so is it typically it says in your bio, it's commercial real estate investors. That's who you're primarily serving. You understand that business. And so that's kind of who it is. And the way that the capital fits, as you mentioned, it's flexible. It gives you have the ability to look at the situation and see where you guys can best fit in. To be able to help.
I'd say we are structured capital for prudent sponsors who have low leverage cash flowing assets.
Yeah.
Provide, like, they might have 10 properties and maybe a couple of them are in trouble. And that sometimes we are not going to attach those assets, but we allow them to fix those problems by attaching to their cash flowing assets in a form that's flexible. And in exchange, we can move incredibly quickly. We can give up to 5-year terms, and we're flexible in how we're structured.
Okay.
I think it's like a way to tap your equity.
No, that's perfect. That sounds amazing. Sounds like a great opportunity. Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. What about on the back end? So tell me a little bit about the structure of Nectar. So I would assume that this is some type of, and maybe it's a bad assumption, but tell us a little bit about how it's structured on the back end. So is this a fund that you have a group of investors that are, specifically investing with you? They've got a specific return that they can count on because they know you're going to place the capital, and these are fairly short terms, so they're going to get their capital back. Tell us a little bit about how all that stuff works.
Yeah. So, again, like, we take everything from a risk perspective, even in the business. And the biggest risk for a company like us is like, the assets in your portfolio have to be strong. And that's why we're only backed by low leverage cash flowing assets from experienced sponsors. But then it's capital. Make sure the capital always has to be there. That's raw materials. So we have 3 different structures. We have an institutional credit partner that has given us a credit facility that allows us to lever our balance sheet. My partner and I sold a lot of properties, and we've taken that to do initial deals, and we've levered that up with the institutional credit partner to do some deals. So if we do a deal, we'll do portion of it into that bucket. We have a fund. After doing deals for 10 years and having really attractive returns, we have a lot of investors who are just interested in whatever we were doing next. And one thing they always told us, hey, we love your deals. I got a 25 or 30 IRR, but it didn't cash flow. I was holding my breath to the end. Do you have something that cash flow? So now we have a fund specifically for those people where, hey, we're paying you a dividend every quarter, and it's consistent. You're 12% or 14%, depending on the class, every single quarter, and is backed by a portfolio of dozens of low leverage cash flowing assets. So that's one thing. And it has accredited investors, a lot of them people we've partnered with for a long time. But we also have opened it up to new investors. And then a third bucket is and the last bucket is it's another vehicle that's specifically for retirement funds. Because ERISA, I don't know how your audience, how in the tax details they are, but there's a thing called ERISA, and you have to have a special vehicle for people's retirement funds. But this is a perfect investment for retirement funds because we pay quarterly distributions, every quarter, and it's 12 or 14%. And that's and if you do it with qualified dollars, retirement dollars, then you get a big tax advantage. So those are our 3 ways we capitalize ourselves.
Yeah, no, that sounds like a great opportunity, and a great opportunity for retirees, for just an investor in general. Those are strong returns. 12 to 14% on a quarterly basis is huge. So fantastic.
Yeah, when you're we're able to drive these returns, and we've made our 100% of our distributions on time and in full since inception. We're able to do this because, again, we are providing liquidity. We can move very, very fast. So it's we feel like we're we're structured to take debt risk, but to have equity flexibility. And so we're able to get slightly higher yields, and we're just transparent and pass that on to the investors, in the fund. So That's how it works.
And from a position standpoint, you mentioned obviously you're not in first position, but you have an opportunity. Let's talk about from a risk standpoint. If the deal didn't go as expected, right? So let's say you lend on a particular deal, like you said, maybe the funds are going to a troubled asset, but the actual the securities is based off of these low leverage cash flowing assets that are performing well. And so what would, tell us a little bit about if a deal was to go bad, like, how you feel you're protecting the investors, from that, what would the process be?
Yeah. So I can tell you, like, we've done over 150 deals in 35 states. So we've seen things. So why don't I talk a little bit about, like, when deals have gone bad, what does that look like in our portfolio? And then what happens?
That'd be great.
Start, like, what does it look like? Well, you have these low leverage cash flowing assets. So what is a deal going bad? What does that look like? The majority of things that have gone wrong in our portfolio have been partnership disputes or sponsors who have, although they have assets that are not distressed, the partner themselves is distressed, or they find themselves in distress, whether it be a partner, a fallout with another partner, or some other part of their portfolio is just sucking in cash, and then they or find themselves trying to pull capital out of wherever they can. So that's been the issues. So what do we do? The first thing is we can directly ACH the account. This the first line of defense, and we have the ability to force a sell of the assets. So we don't have control rights. Is not a count as a change of control. We're structured very in a way that makes it that we do not interfere with the underlying first mortgage lender. However, we do have something similar to major control rights of an LP, where if there's a default, we can step in, take over, and sell the asset in exchange, get paid our principal, our proceeds back, principal and fees. And so we've had to do that. Where we step in, say, hey, whatever's going on, we're going to take over and sell the asset. And that's generally how it's gone.
Okay. So in that case, they actually, as part of the structure of signing the paperwork and everything, they're basically allowing you that opportunity to be able to, hey, look, if check this box, and this box happens, which is bad. That means we can come in and we have the ability to sell the asset at that point.
Yes. And we've had to, most of the time we're able to, we also have a personal guarantee. So most of the time we're able to escalate in a way where we can leverage our relationship. We go out and we meet all of these sponsors. It's a relationship where we can, say, hey, look, this needs to happen and we need to do it, so you should do it. And in 90% of the cases, there haven't been, I guess like 80 something, just because there haven't even been 10 cases. But let's say 6 or 7 of the times that this has happened in the past, the sponsor just really, they get it and they go and they sell the asset, and we provide pressure to make sure that there's on a time frame, and that's kind of how it's happened. And we have had a situation where we've had to go directly to the lender and broker and sell the asset. And even then, before, when the sponsor really saw, hey, we go to court, this is happening no matter what, they came in and they were able to bring
cooperated.
Yeah. Ultimately, this, like, if you have 30% equity, I don't care if your 30% equity gets wiped out. On average, across our portfolio, we're at 65% LTV. That's our last dollar. So if there is an issue and we go and are forced to sell, we're going to sell it at a discount. We're going to sell it and clear the market and move on. So a lot of times buyers, they come and say, hey, the owners, they say, hey, I will sell it so they can get max value. Because if we sell it, our max value is at 65%.
Yeah, makes sense. It kind of forces the hand to be able to do it, and and again, this is a situation where you've already come in and kind of helped save the day on a lot of their other issues or things that were happening, or a need. You've provided a need for the capital, and so obviously we're talking about just not ideal situations for the investor that's involved, but it really just kind of want to give that perspective from investors that would be investing in Nectar, that there is an opportunity to be able to correct any issues that happen. And because the leverage is so low, that kind of hedges against the risk. So,
yeah. And going into these situations, we have had value degradation where we were at 65%, and now we're at 70%, or 72%. But still, with that value degradation, we've have a lot of cushion, to sell. And the key thing is it doesn't happen. It hasn't happened very often, even after 150 deals. But we have had higher returns on our defaulted deals than our portfolio, because we charge fees, their interest, their penalties, and because of our leverage point, we've been able to collect those fees and penalties.
Fantastic. How about just maybe for the audience or somebody out there listening that says, hey, this sounds like a product that I could use. I've got, this, and this, but I have a need over here. What, from a timeline standpoint, how quick, and tell me a little bit about the application process, what that looks like, how you vet them, and then what, how quickly they can expect to receive funds.
Yeah. So we are able to work very quickly and efficiently. Because we have a real estate and finance and risk company. That's how I think about it, because we take risk for a living. And we have a technology company that's builds technology, and they're a risk company also, because they mitigate risk and help us go faster. So we're typically able to turn around a deal 7 to 10 days from beginning to end.
Oh, wow.
With repeat sponsors who have all of their, everything in a row and get everything in, we've closed as quickly as 3 days. What does the process look like? Typically, we'll ask for an initial set of documents that are just easy and quick, where we can tell you pretty much whether, we'll get a P&L, we'll get a SREO, a schedule of real estate owned. We'll look for a mortgage statement, because we're going to, most of the time, we'll be behind a first mortgage. So we'll get a couple of core documents, and we say, hey, this is pretty much what we think we're going to be able to do. You do a borrower questionnaire, because you can just answer some questions, where it's like, if you tell us the truth, we'll tell you what we're going to do. And then after that, we can give you a term sheet, or a quote. Then we go and just verify all the things in the borrower questionnaire. So we ask for primary documents. The things you would think you need, we're going to need entity docs, we're going to need, mortgage notes, we're going to need, make sure you pay your taxes and all of these things, insurance. But again, most of the time the holdup is, in the very beginning, we say, hey, here's the checklist of the things you need to give, and it's in our product. Some people can give it that day, and then those deals are closed a week after. Some people, it trickles in a little bit slower. For over a certain deal size, we do a site visit. However, we have a team that's just ready at any time. We can schedule a site visit today and be there tomorrow. So we can move pretty quickly, but that's how it goes. Usually it's the site visit and getting the sponsor collecting the docs that takes the time.
Yeah, for sure. With most lending, it's usually a person that's actually borrowing that slows things up, but by not having their stuff organized or having to pull it off for the first time in a little while, or whatever the case may be. So certainly can understand.
Well, that's why we have, for our repeat borrowers, we ask for a lot of documents. Sometimes our borrowers just give us everything for their portfolio, and then if they ever need it, we have a technology product. They have access at any time. We have access, and we can do deals that's why those deals can get done in 3 days. You tell us you want to do it. We have the docs. We're linked to in our system. We have to fly out there, and then boom, we can get it done.
Yeah. Okay. Makes sense. Now, did your wife, Brittany, did she have any background in real estate before, or did you guys founded this company together? What did you drag her along kicking and screaming, or was this something that she had interest in as well? And just curious more than anything else.
Yeah. My wife and I have an interesting story. So we started out in the same dorm room in college. I mean, there were times we were in the same dorm room. We were in the same dorm building,
Got it.
let's say, in college. Um, and so we've known each other for a long time, and we are very, very strong in very, very different things. But started our first organization together when we were teenagers. We started, a business or ran a business together in college. For our wedding, we ended up having a very, very expensive wedding, and I didn't know how expensive weddings were going to be. So we started a import-export business together, and made in a couple of months $60,000 to pay for our wedding, then some. So,
Wow.
so we've been in multiple ventures together. When I was doing the real estate deals in Atlanta, she was an executive at Abercrombie. She ran the $120 million business for Abercrombie & Fitch. I forget the name of it, but started partnering in these real estate deals. So we started partnering together in real estate deals even before we were married. So she had her own portfolio in her own right. She ran asset management at our. She ended up leaving that job. We got married. She ran asset management at our real estate business.
Got it.
So she managed most of our portfolio. She also had a 125 unit short-term rental portfolio. So
wow.
that she had only managed her own right. So I would like to say that my portfolio was bigger, but in terms of hers is probably harder.
Right. Yeah, sounds like.
Yeah. So
Yeah, I would
that's how.
imagine.
And then, like, when I started Nectar, actually, she was like, "Yeah, you can go do that weird financing thing. I'm going to do this real estate thing that actually makes us money." So she didn't start out she started out saying, "I'm going to keep doing this real thing." But then when Nectar started really growing and we saw that there was a need there, and we saw that a lot of sponsors need flexible capital, and she saw that we were putting a whole bunch of our personal net worth in there, she's like, "Okay, let me hop in."
I better pay attention to this then. That's awesome. Well, that's really cool. That's neat that you guys have the opportunity to do that together. And it sounds like it is, one of many ventures that you've done in the past together. So
it is, but hopefully this is so far is the best one. Now we've grown substantially. We have a large, not large. We have a team of 15 now that we manage, and we're in 35 states. Over 9,000 units that we finance. So we've gotten, we've made something of it, and it's an incredible journey to take with an incredible partner.
Yeah, that's awesome. Let's talk a little bit about geography. You mentioned how many states you're in. Is that just happen to be where the deals have happened? And I guess, tell me also maybe a little bit about how I would assume there's a lot of word of mouth after the first couple deals, right? You're somebody that's referring, that kind of thing. But how are you growing? And what's the strategy for the states that you're investing in?
Yeah. So originally we built a broker portal effectively that we sent to several brokers. We started out with smaller deals because when it was our capital, we said we had three things that we needed. We wanted to be low leverage, cash flowing, and diversified. And when it was just our capital, we didn't have enough money to be that diversified doing all these big apartment deals that we're doing now. So we were doing smaller deals at the time. So we've been geographically diverse from the beginning. And that's the point. So we built a broker portal. Originally, it was for single family debt brokers, where they could we send it to them. They send deals through, and we would finance the deals through that portal. But then we have a big network of brokers, and now we have expanded that to commercial real estate. We also have an originations team that go to conferences and events, and we identify markets that we like. And we'll say, hey, we're going to take a month where we're going to go after this market. So Jacksonville, I think, is the one that we're on now. We identified all the sponsors in Jacksonville that have cash flowing properties. We have CoStar. You can see, CoStar, reporting on CMBS properties. So, okay, this is the universe of people who have deals that we like. Here's the universe of brokers who finance or did those deals, and we reach out to every single one of them. That's kind of we come. here's a quote, here's how much we can get you, need a couple $1,000,000. And most people say no. But every once in a while someone says, yeah, I could take $1,000,000. And then that's kind of how we.
Yeah. No, makes sense. No, that's fantastic. And so with that, are there any areas or any particular states that I don't know from the lending standpoint, or if there's certain states that the regulation is just, too difficult, or, maybe just the economics around that particular state. But tell me a little bit about, kind of areas that you've said, maybe not in this area.
So, the states are different, okay? And the laws are different, and that makes a difference for us. So I'm not going to say, but again, our things are, is it cash flowing? Is
Right.
it a high quality sponsor? Is it a prudently leveraged portfolio? If it has these three things, then typically we can figure out the rest. Now, there are some states that it's a lot easier that we're, to be honest, we're not going to, which means that the security package might have, the teeth are going to be different than in other states. I know I'm not being specific here, and if Brittany was on, she could be more specific. But we're looking to be diversified. So if you come on any day, we might say we don't like Texas right now because we're just balancing a diversified portfolio. But in general, we want to be in all we want to look like America. We want our portfolio to be diversified. So, as long, if we're low leverage and cash flowing and you're anywhere in America, you're probably going to be doing pretty good.
Yeah, exactly. And it makes sense, and especially just kind of the way that you're structuring these, again, a lot based on the jockey of the deal, and, kind of what their portfolio looks like. You can find a way to do business everywhere. I would expect. So that's neat. How about, tell me maybe a little bit about, you mentioned having a couple different options, whether it be the retiree that invests in the fund, the individual investor that invests in the fund. What does that look like on their end from maybe a portal standpoint? So if somebody says, "Hey, I've got $50,000, $100,000 that I want to put in to this," what are they seeing on their end? Are they seeing the individual investment, what it is? Are they reviewing any of that prior to, or is it just being part of a collective fund, and then you guys are making the decisions, but maybe you let them know on the back end that part of their monies is in this, and this? I guess just always curious how that's reflected on from an investor portal standpoint.
Yeah. So we've done it in different ways because you've had investors ask us to do it different ways. And when you're starting out and you don't have that much, it's like, oh, we'll try everything. But then you learn, okay, some things, they don't work that well.
That's right.
So the way that we are doing it is the majority of investors come into a fund. The fund is the best thing. People want to pick individual deals, and I understand that, but the fund is diversified across dozens and dozens of deals and across the country. And so we can say with a lot of certainty that you're going to get paid. Everyone has been getting paid. And you have a portal. We have a portal. You can see the underlying investments in the fund. So we are transparent with that. You can see what they are, where they are, the asset class, the metrics. You can see a one pager of how we look at it. We do quite an extensive due diligence. So we have we have a very big memo and a lot of actual individual details that we don't make available for privacy purposes. However, once if you're in the fund, you will see a one pager, you'll see all the important metrics. And if you're interested in going deep in a deal, then we can do that on a one-off basis, depending on, are you trying to, what kind of check are you trying to write?
Right. Understand.
Because we do have some people who've been invested in the fund, and they say, hey, actually, I just want to be in these deals in the Southeast. Can I buy $5 million of these deals out of the fund and do some deals that you're doing going forward? And those we have in just one-on-one conversations, and we can be very, we can give you the diligence in that deal. That makes sense. But the majority of investors are in the fund. That's the best place to be. We've had individual investments, but some of them, they might have a month where they don't pay. And for us, it's not a problem. We are really good at getting them caught up. But if that's the one deal that you invested in, or if you're $50,000, you can be very unhappy and you want to be in the fund. So that's
right.
typically how we do it. Invest in the fund, and then you can buy individual participations of the deals once you're in the fund. Or if you want to do a bigger allocation, we can have a one-on-one conversation.
Yeah, yeah, makes sense. Makes sense that it would be structured that way. And you're right. I mean, the fund is, the beauty of the fund itself is that it's going to give you that diversification. And part of the way that fund works is there's going to be good ones within it. And hopefully, the majority of them are good ones. But you can't if you're doing enough business, there's going to be a bad apple here and there, or a troubled one that you're going to have to somewhat overcome. And because it's part of a larger group, the economics still work for the fund itself. So,
right. Yeah. And we structured it such that every deal has a payment reserve where we hold in our balance sheet payment reserve because there's volatility. That's the reality. But when you're a real estate operator, sometimes the taxes were up more than you thought. You have to come out of pocket. The insurance was different from you expected this year.
Yeah.
A bunch of turnover has happened, and we want to be flexible because we are structured to be flexible. But if we sell you that individual deal, then it makes it harder to get that flexibility. When a lot of these, they're great sponsors. It's just they need to not pay for these couple months so they can pay the insurance, and they'll catch back up. So we like to be able to provide that flexibility, and we do that by having most of our investors in the fund, so that we can just say, "Hey, we'll cover it, and it's no problem." And typically, it isn't a problem.
Yeah, makes sense. That's great. Well, this has really been very interesting. I think there's a huge demand for this type of financing with commercial real estate investors. And so hopefully, the audience has seen that. And I think it's also equally a great opportunity for individual investors that want to have an opportunity to participate in something like this. So, Derrick, where can people find out more about Nectar, more about you? What's the best way for them to learn more and connect if they want to on the investment side?
Yeah, the best way is, use nectar.com as our site. You can find a lot of our postings on LinkedIn, and we have I've written a lot, so I have Scotsman's gotten a lot of things out there. You can Google their video and articles written, so you can kind of see how we think about risk. Because as I said, we're first and foremost a risk shop. Where do we want to have risk? And we're a cash flow and leverage shop too. As I said, basis is what we think about. But that's where I go. But use nectar.com. If you reach out, we can, we have people who will reach out to you immediately and get you any information you want. If you're interested in the fund, down to the individual, you can see the deals that we're doing.
Perfect. Sounds really good. How about, I've got a couple more questions for you that I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
As a sponsor or as an investor? Because I'd
say as an investor.
As an investor, I'd say two things. Leverage and basis matters. So when you're thinking about what deals you're looking at, just what is the valuation that you're going in at, whether it be an equity or whether it be a stock, whether it be equity in a real estate portfolio, whether it be debt, basis matters. And it's easier. Either you can be an investor that does deep homework, and if you're a deep homework investor, don't. It's sometimes okay to just start in your backyard. I saw a lot of real estate investors say, "Hey, what market should I invest in? Should I invest in Florida or Texas or blah blah?" I'm like, "Well, where do you live? What neighborhood do you like in your neighborhood? What neighborhood do you like in your that, and you can do deals there." So that's why I say, if you're going to be a go deep investor, then do something that try to focus and go deep. But if you're going to entrust your money with somebody else, then they need to have their money in. They need to have a track record of making money with their own, and they should have money to put in because they have that track record. Right. And they should be at a basis. They should be able to explain to you what is their basis and what's going to happen if, I'm kind of a doomer, right? So like, I think that the world
That's
is
good.
over leveraged, the government's gonna default, like all that stuff. So like, now, I'm not saying that I'm right. I'm just saying that like if I'm gonna invest in somebody else, they should have answers to these questions. All right, like what happens if if we are in a major cycle and there's going to be a major deleveraging? Okay, what happens to my investment, and what are you going to do? Does that
No, I
answer your
love it.
question?
I think that's great advice. How about a book recommendation? Doesn't have to be real estate or finance related, but it certainly can be. Just something you've read that has been impactful.
Yeah. So I have one that's business related that I absolutely love. Ray Dalio is the founder of Bridgewater. He wrote a book called Principles, and it's just like principles of building a business, principles of investing, principles for life. And I think it's an outstanding book. And Ray Dalio is an outstanding investor. That's why I built the biggest hedge fund in the world. He also has a book called How Countries Go Broke, which is he did research on basically major power countries going back for 500 or 750 years and just showing the arc of what happens. And so in Principles, he did that with the debt cycle for companies, but then there's a major debt cycle for countries too. And the public and private debt cycle is similar. There's small debt cycles, and then there's a big debt cycle. And he wrote all about it. So I'm super into that type of stuff. So I would say Principles by Ray Dalio. And if you have time for a second one by Ray Dalio, How Countries Go Broke, because I think that, it's topical to what we are experiencing now.
I would agree. Well, fantastic. Those are both great recommendations. I've done Principles, but have not done the others. So I will check it out myself. Derrick, this has been great, man. I appreciate you being a guest on the Wealth Flow, and I think we will call it a show.
Awesome.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.